Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at Netflix and Snap before their upcoming earnings releases next week to see if either of these tech stocks should be considered longer-term buys. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into Netflix and Snapchat, or Snap Inc., as the company is actually called, I want to quickly just review where the market is and take a look at the broader earnings picture before we look at those two stocks to give a more clear picture of what's going on. So the NASDAQ popped roughly 0.5% through morning trading on Tuesday as it tries to reclaim its mid-February peaks. The tech-heavy index is now up about 11% since it fell into a correction on March 8th, and it now rests just about 1.8% below those mid-February records, having surged about 7% since March 30th alone. So really strong start to the second quarter for those tech stocks that had been beaten down. Meanwhile, the S&P 500 touched a new record on Tuesday, and at the moment, we should note that, the NASDAQ's now up about 7% since March 30th, and the S&P 500 is up about 4.5%. And then so far for the year to date, the NASDAQ is up about 8.2%, and the S&P 500 is up about 10.5% since the start of 2021. So Wall Street investors obviously continue to monitor these inflation worries and inflation expectations amid those rising treasury yields. But despite that, the U.S. Treasury yields remain low by historical standards, which likely creates the prolonging of that TINA, or there's no alternative investing, and the wave of new retail investors are certainly helping things go along even higher. So that's continued reason for this bullish sentiment. Along with that, despite the J&J news, the vaccine rollout continues to go well in the U.S., and some of the hardest hit areas of the economy are starting to bounce back in a big way as things return closer and closer to normal. Meanwhile, the possibility of 6% or higher U.S. GDP growth, which would be its best in over 30 years, has cyclical areas of the economy such as energy and finance bouncing back in a big way. And we've seen all that since the November election. And if we look back since the start of the year, we can see that the big banks, so we'll look at just JP Morgan. JP Morgan's up 23% since the start of the year. And this is compared to, say, high flyers like Tesla, which is down about 5%. So you can see that little bit of switch from those high flying tech stocks that had done so well over the last year, certainly heading into the new year. And we've seen the return of that cyclical movement. With all these fundamentals, obviously, it's boosted by this easy money policy and the ejection of trillions of dollars into the economy. So that's more of a reason why you've seen some of these banks and energy stocks bounce back. We continue to see positivity all over the place. And then we saw last week, JP Morgan CEO recently wrote in his annual letter to shareholders that the U.S. economic boom could last until 2023. So that's real big positivity from the head of one of the biggest banks in the world. And with this in mind, the quarterly earnings picture for Q1 of 2021, our Zacks are now calling for about 20.4% earnings growth on 5.6% higher revenue growth. This would crush last quarter, where we saw about 3% growth on both the top and bottom lines. As we continue to see these estimates trend up and up and up, this 20.4% growth is up big over the last several months. And then if we look ahead, we're continuing to see big growth expectations for the rest of the year. So with this in mind, we're going to go ahead and take a look at Netflix, which is set to report its first quarter fiscal 2021 financial results a week from today. So next Tuesday on April 20th. The streaming TV stock has lagged the market over the last 6 months, up just about 2% versus the S&P 500's 20% climb. With that said, the stock has popped 12% since March 8th, and it rests about 7% below its January records at around $553 a share as of Tuesday morning. So let's see what's going on with the company that posted blockbuster year in 2021, having added 37 million paid subscribers to blow away its average of about 23 million over the past 5 years. So despite that showing, though, as you mentioned, the stock has lagged the market over the last 6 months, and it's lagged far behind the only other true pure play streaming TV stock, Roku, over the last year. The streaming TV revolution has helped propel Netflix to be one of the best performing stocks over the last decade, but things, as we mentioned, have slowed down, certainly over the last year and over the last several years as well. Netflix ended 2020 with 204 million global paid subscribers. And compared to Disney, Disney now closed, so Disney Plus, which is a far newer platform, closed the year. It last had about 95 million paid subscribers, and it raised its forecast to between 230 to 260 million subscribers by 2024, which would be really, really impressive growth for a company that just launched its streaming service back in November of 2009. So amid all of this, that's why there's maybe more and more worries about Netflix. Disney's quick growth, which was driven in part by the pandemic, comes as more and more of these big tech companies such as Apple and Amazon and even AT&T and others continue to put more and more money into that streaming services, which is going to be the future of television. So now we're going to jump into just a little bit more of Netflix. So Netflix, as we mentioned, that at-home entertainment space has helped drive them to a world-beating 10-year run during the 2010s, one of the best stocks during that decade. As you mentioned, though, this past year, it's been a little hard despite really awesome conditions for the stock with theaters closed. But on a positive sign, theaters have slowly started to reopen. That Godzilla vs. King Kong movie has done pretty solid numbers, so maybe there's going to be a push to get people out of their homes. As we mentioned, those conditions helped Netflix add about 37 million paid subscribers in 2020, blew away its average of about 23 million over the past 5 years. And the company ended the year on a really impressive note. It added 8.5 million users in Q4, 40% above its estimate. In that helped it see its stock soar right after it wowed Wall Street in late January. So along with its impressive subscriber additions, which have traditionally driven the stock. So if it beats over the past decade, if it beats subscribers, the stock price moves. But along with that, the company projected that it would post break-even free cash flow in 2021 instead of its last projection that called for it burning as much as $1 billion in cash. So that really had Wall Street clapping for the stock, which had been struggling and continuing to take on debt as it tries to roll out as much content as possible in order to thrive and continue to compete in this increasingly crowded space with some of the biggest companies in the world, as we touched on earlier. So the company also mentioned that it no longer needs to raise, quote, external financing for our day-to-day operations. So once again, that is really positive news. So with this in mind, we're going to go ahead and take a look at what to expect from the first quarter and the rest of the year for Netflix. So this quarter, Zach's estimates are calling for about 24% top-line growth to about $7.1 billion, and we're calling for 90% growth on the bottom line, all the way up to $2.98 per share in terms of adjusted earnings for the full year. Then we're calling for about 20% growth, all the way up to $30 billion, and then about 61% growth on the bottom line for the full year 2021. So to put this into context, the company did 24% top line growth last year and 28% top line growth the year before that. So 20% growth is a little lower than that, but it's nothing super out of the ordinary. And as the company makes more and more money, these top line growth figures get harder and harder to be eye popping. But we're calling for that 16% growth in 2022. So a slowdown, but still they're going to be making $5 billion more this year than they did last year. And then if we look ahead to 2022, they're expected to go all the way up from 30 billion this year to 35 billion in 2022. So continuing to grow that top line, just the percentages get harder to be eye-popping. And then we're calling for another 31% growth on the bottom line in 2022. With this in mind, the company's earnings estimates for Q1 have climbed recently. Overall, they've also climbed for the full year. They still, though, despite some of that positivity for Q1, the stock holds a Zacks ranked number 3 hold at the moment. With that said, the stock has 22 strong buy rankings or ratings for brokerage recommendations that we have, and that's out of roughly 30 or so overall ratings. So 22, and then we have 2 more at a buy and only 2 at a strong sell in terms of brokerage ratings that Zacks has at the moment. So some big positivity for Netflix overall. And then we can see that the stock has traded far below Roku, as we mentioned. So that's that only other real pure play player that the stock has been on a massive run over the last several years to really trounce Netflix. But that's because Netflix was such a big performer in the 2010s. So Netflix is currently trading at about 7.8 times forward 12-month sales estimates, which is below its own year-long highs and right near its own year-long median. So positivity on the valuation front, and that's just trading at a big discount to Roku, which is trading at about 17 times forward 12-month sales. So with Netflix trading at 7.8, Roku's trading at 17. So good on the valuation front. So if we look over the last 3 years, though, we can see that Netflix is up about 80% compared to the S&P 500, 60% climb. So as we mentioned, this has been a strange last 3 years for Netflix stock, but the last year, it's certainly outpaced the broader market. Netflix has also proven that it pays to be first as it continues to grow despite competition from all the companies we mentioned, Disney, Apple, HBO, and others. And there's also certainly room for it to grow as it expands outside of the US and more people disconnect from legacy media, as we've mentioned as well. And unlike Spotify versus Apple Music, the streaming TV industry is hardly a zero-sum game, since the TV platforms, for the most part, offer completely different content libraries, and Netflix is continuing to do all it can to have the most attractive content to get people to continue to invest in the service. And as we mentioned, there's no reason why people don't have a Netflix account and a Disney Plus account and an HBO Max account. Maybe in 5 years, someone even starts to bundle all this and it starts to look kind of like your current TV subscription if you still have that traditional cable package. So long term, it still seems like Netflix is a solid hold for a streaming world that's really just getting started, and it's not going to ever reverse. But maybe investors want to wait until after the company reports its earnings next Tuesday. So now we're going to move on to the other stock we're talking about today, and that is Snap Inc., which trades under the ticker that's just its name, SNAP, and they report their first quarter 2021 financial results on Thursday, April 22nd. So next Thursday. Snap, it started as that company that was really famous for its disappearing photos and videos in that social media world. And it's really bolstered far beyond that to become a pretty impressive platform in the new wave of entertainment. This includes rolling out far more video content in what it calls shows. They're shorter shows. They have partnerships with Disney, the NFL, celebrities like Kevin Hart, and it's really become a hit with lots of younger people. Snap's Discovery page has also gained a lot of traction in the booming mobile gaming market. And it's become a very important player in the mobile gaming market as well. So the Discovery page is gaining a lot of traction with advertisers. They're also in the mobile gaming space for the last 2 years. So that's a really big growth area for the company. And the company also consistently releases various augmented reality offerings, which is sort of its bread and butter. And it also launched its Spotlight feature late last year that aims to take on that up-and-coming platform of TikTok. Snap's also beefed up its portfolio of entertainment offerings to attract advertisers as more people, as we mentioned with Netflix, continue to disconnect from legacy media. But Netflix is a good example of why Snap is a solid investment in the sense that people are paying to avoid ads on Netflix, in Disney Plus, and other outlets. And as digital advertising has been really prominent over the last decade, people have grown to simply ignore traditional online banner ads. So anywhere where you can see a real good return on investment is a good place for advertisers. And Snap's shown that it's really a positive place for advertisers. The company has boasted that in the U.S., this is really a mind-blowing number, that it reaches more than 90% of 13 to 24-year-olds and more than 75% of 13 to 34-year-olds. So the company said that, in fact, in Q4 of 2020, that over 90% of U.S. Gen Z population watched shows and publisher content in the fourth quarter. So that's just a massive number, and that alone might be reason to consider the stock as both a near-term and longer-term play as we live in this vastly changing entertainment space where people are glued to their smartphones at all times. So Snap's ability to reach what it calls an unduplicated and hard-to-reach audience has attracted Wall Street's attention, certainly recently, as it continues to add users and monetize its growing platform. And we should also note that Facebook and Twitter and some of its other, I guess you could call it direct competition, continue to face more government scrutiny, while Snapchat hasn't really had to deal with it because they don't have as much pull over what well, we're not even going to get into that, but people know the story about what's going on with Facebook and Twitter, and Snap's not dealing with any of those big problems. So if we look back, the company topped our Q4 estimates in early February, with its daily active users up about 22% to 265 million. And overall, its full year 2020 revenue climbed 46% to 2.5 billion. This marked its third straight year of roughly 45% sales growth, and its outlook continues to be very impressive. So Zacks estimates are calling for Snap's FY21 revenue to climb 52% to 3.82 billion, with FY 2022 projected to climb another 45% to 5.3 billion. So this would be, as we mentioned, that would then be 5 straight years of about 45% or higher growth, which is really, really impressive. Meanwhile, it's expected to soar from an adjusted loss of 6 cents per share last year to positive 12 cents per share in FY21, with FY 2022 set to skyrocket all the way to 57 cents per share. So from a loss of 6 cents per share in 2020 all the way up to positive 57 cents per share by 2022, which is another reason to be optimistic about the stock. Wall Street has now fallen in love with the stock recently, that had largely failed to impress since it went public in 2017. Snap is up about 350% in the past 12 months and 130% in the last 6 months. That said, it did get caught up in the wave of tech selling that we've talked about at the top that saw the NASDAQ fall into a correction in about a month. With that in mind, at $62 a share, it sits about 12% below its February records. And on the valuation front, Snap is trading at around a 30% discount to its own year-long highs in terms of forward 12-month sales at about 22 times forward sales. Snap is also consistently trading at a discount to other high flyers during the pandemic, including Shopify and others. Snap currently lands as Zacks ranked number 3 hold, as does Netflix, based on some mixed earnings revision activity. Yet 21 out of the 29 brokerage recommendations Zacks has for Snap are strong buys, and investors might want to consider buying it as a longer-term play for the modern media age, and it continues to play into that overall smartphone addiction and continuing to adapt and attract a vital demographic in this new entertainment age. So like Netflix, Snapchat seems to be, at least certainly in the near term, in terms of maybe who knows what the entertainment age is going to look like in 30 years in terms of, it's just impossible to project, but certainly in the next 5 or 10 years, it's kind of hard to imagine that Netflix and Snapchat aren't going to be able to continue to attract new users. And with Netflix continuing to attract that streaming service demographic, and for Snap to continue to have this young, loyal following that's going to attract digital advertising, which is continuing to boom as it overtakes that legacy media and more ad dollars go online. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.